Okay, so please, everybody, we have a great next panel coming up. This final panel of the morning session is sponsored by the Securities Traders Association, the STA, and covers emerging trends in trading, ETF trading. Andrew Sarowick, Portfolio Manager, Exchange Traded Concepts, will moderate. Thank you very much.
Hey, good morning. My name is Andrew Serwick. I'm a portfolio manager and executive committee member at Exchange Traded Concepts, which is a white label ETF issuer. We also act as sub-advisor to a number of funds, and we provide consulting services to firms that are looking to launch ETFs. I've called myself an ETF lifer. I've worked in ETFs my entire life. My first memory of ETFs actually was when I was still in high school, I think at the time. I would watch the nightly business report, and I saw this Standard & Poor's Depository Receipt was always one of the most active Amex symbols. Like, what exactly is that? So fast forward 2 or 3 years later, and there I am working on the floor of the Amex behind Amex Post 19 where SPY traded, and that's basically what I've done ever since. I'll give a moment for the other panelists here to introduce themselves. I've known many of them, some of them from the floor of the Amex from many years ago.
Thanks, Andrew. Steve Caperso, Old Mission Markets. I'm also a veteran of the Amex, about 20 years experience in the ETF realm. Started over at Old Mission about 2 years ago. I'm head of ETF issuer relationships. So basically, if you're looking to list a product, listing a product, you're looking for an LMM, you reach out to me, we kind of talk about the product and go from there.
Chris Hempstead, I'm with Murray Asset Securities, also a veteran of the Amex. I started out of college down on the floor and then moved into ETFs in '99 with the launch of the QQQ. Also at Murray, we act as a lead market maker, portfolio trading desk, seeding, and all the things that I think the three of us collectively do for the managers. Long storied history. We've all known each other quite a long time.
Josh Califf, most definitely not a veteran of the Amex. I've been at Flow Traders for only 7 years, always on the ETF side of the business. Flow Traders is a global ETF liquidity provider. We've expanded into other asset classes, but the ETF is really our core focus. I sit on our institutional trading desk where we provide block liquidity in about 3,000 plus ETFs to buy-side clients that range from asset managers, pension funds, insurance companies, hedge funds. And then I also split time focusing on our lead market making business, where we work with issuers to bring ETFs to market, provide seed capital where appropriate, and then help with the ongoing maintenance and rebalancing of various ETFs.
I see everyone has mentioned lead market maker. I know the last panel that was up here mentioned another unsung hero of the ETF business, the custodians, but I really feel the LMM is one of the unsung heroes of the ETF business. It's what I did for about 18 and a half years. Everyone's kind of mentioned that. That's something we should talk about. If you're a new issuer, why is the LMM important? What does a day in the life of the LMM look like? I remember it's very often being the one who's setting the price. Firing off these quotes into a vacuum every day, and probably hoping nothing trades, or if you're successful, nothing might trade. At least right at 9:30. Tell us about some of the challenges of being an LMM, and why is it so important for a new issuer?
I'll take a shot. We talked about it on our prep call a little bit, and I mentioned it with Bob Pisani last week. There's 3,750 some odd ETFs listed. 750 of them, the top 750, make up 98 plus percentage of notional trading volume in ETFs. So what does that mean for the three of us? Maybe Old Mission and Flow Trader a little differently. Their systems are much more mature than the ones I've built, at least for strategic market making. Those top 750 ETFs trade like water. They really don't need an LMM, right? They've matured. They've got supply and demand in the market. There's thousands and thousands of users of these ETFs. They have natural liquidity, natural spread. And in times of dislocation, the market makers will step in and serve a real purpose. Think March of 2020. But the 3,000 ETFs that collectively make up 2% of volume or less, they're mostly quoted and not traded. And it's a really important observation for people in the room to know that volume doesn't really beget liquidity. The quotes really will define where you can buy and sell an ETF. And so as a manager of ETFs, they're dependent on their wholesalers to go out and talk to advisors to buy their ETF. They certainly don't want them to sell it. And they don't want to open up the screens and see the spread, 100 basis points wide for a portfolio that might only be 10 basis points wide. So we stand at the ready as old school Amex specialists, and you would have been had you been born before 2015. You would have been, Josh. You would have been hired in a heartbeat. But the old school specialist model was to provide a fair and orderly market. We priced up the ETFs. Brokers would come in on behalf of the clients and advisors, ask for a market, and we would make a bid and an offer that's expected to be fair and orderly. Fast forward post-Reg NMS, the automated electric market that we're in right now, we're doing that systematically using technology and very fast systems and very fast, security checks and risk checks to be able to be out there all day, every day, just in case the wholesalers tap on a good door and get a buy order. Okay, that's, I think, summing up why it's so important for the managers and the sub-advisors of ETFs to have market makers at the ready.
Kind of add to that, overall, the lead market maker is kind of like the face of the market making firm that you're working with, right? So we so that relationship, starts off, and when an issuer comes out, whether we get a referral from a custody bank, an exchange, a distribution partner, say, hey, talk to this new advisor. We're looking to bring a product out to them, kind of go through the logistics of what an LMM does, as Chris explained. The big thing with an LMM compared to a regular market maker is that you're committed to be there in the inside quote for, I think it's like 80% of the 10 to 15% of the time, and you're also there to provide liquidity for a lot of the instances where, the last other panel that was on was talking about the 351 exchanges, where people are in SMAs and mutual funds before, where they know every day, closing at 4 o'clock in the afternoon, what their mutual fund price was, or the portfolio was marked to. So they convert to an ETF because an ETF theoretically has a lower management fee than a mutual fund for long-term investors. So the job of the LMM is obviously not to give the investor the experience of paying a load on the spread, as Chris had mentioned, kind of keep the market as tight as possible. And obviously with the ETF has been said a million times. The underlying basket components are how liquid those are, is how liquid the ETF is to make a market in and to go through the create and redeem process with it. So I just think the LMM is a key part of the whole ecosystem. The exchange as a whole, I didn't do my little STA plug since it's the STA panel with Jim. The point of sale is the exchange for an ETF, right? So anything that happens with market structure, anything happens with quoting, anything that happens where if your advisor sends a market order and it busts through all the liquidity, that the screen liquidity, and there's no one there in the back to kind of have liquidity available, so you prevent those quote unquote hockey stick prints that no one wants to see, from the exchanges to the lead market maker to the end investor to the broker that put his client into the ETF.
I think it's also important to note that, all these trading firms that are providing liquidity in ETFs, it's a highly systematic endeavor. So for example, at Flow Traders, we have about 90 people in our US office. We're quoting thousands of requests for quotes off exchange every single day. We're the lead market maker on 225 different ETFs. Outside of that, we're also quoting hundreds of ETFs on exchange, not as the lead market maker. We're quoting products in fixed income. So it's all to say that the ETF is something that we're obviously very focused on, but we're doing it at thousands of different products. One of the things that wholesalers and ETF issuers focus on the most is obviously liquidity. That can be the make or break between making a sale, convincing someone to allocate to your fund, really pitching them that this product has some sort of value in their portfolio. So a lot of times we're doing this systematically, where people are, an issuer might be focused on 2 products, 5 products, 10 products. As a firm, we're doing this with only, dozens of employees, doing it highly systematically, and really try to focus on our lead market making obligations, because again, it's exactly what it is. It's an obligation, but it's all to say that we're doing this very systematically, electronically, with a high level of efficiency. So we focus on doing that across all our different products. So that's kind of the general gist of how we're looking at it. And the challenge is that we're doing this with a handful of people, but there's tons and tons of products that are coming to the market that we need to focus on all day, every day.
Yeah, and touching back on something Andrew said, we'll revert back to the Amex. I really think it's a good sounding board for people to understand the history of market making and the history of where we came from. A market maker on the floor, a specialist on the floor, whether it's an equity or an ETF, really could only handle a certain number of products. Maybe the average was 12 or something like that. It may in QQQ it was one, or SPY it was one. But the automation and the technology that's allowed firms like Flow Trader and Murray and Old Mission and others to do things on a much bigger scale, allows a smaller number of traders to do a multitude of more products. Andrew said something about quoting it and being, I don't want to trade. We don't like surprises. Market makers generally we build expectancy into pricing. We build expectancy into volume. When we come in on a given day, if I've been quoting an ETF for 6 months and the average volume is 1,000 shares, and I wake up and I turn on my machine at 9:30, and in the first 2 minutes I've sold 100,000 shares, the first thing I'm thinking of is I've got something wrong. I'm being rolled over and picked off. And so I'm probably going to widen out and take a closer look. More times than not, if we're doing our jobs right, we're not getting picked off. More times than not, you found an advisor or got added to a model that is taking off like gangbusters. If you think your ETF is going to go from not so popular to very popular, it'd be a good idea to start making phone calls and letting people know that you're optimistic about the future of the ETF. Maybe talk to different market makers that you work with to make sure that they have sufficient liquidity in the market so that market makers aren't caught off guard and widen their spread for a momentary lapse of check. Because when that happens, the price will, as Steve alluded to, hockey stick up or hockey stick down in the case of sales. Surprises aren't good for market makers. They're okay. We get through them pretty quickly. Our checks and systems, I think I can speak for all of us, can reconcile things very, very quickly. But retail investors and model investors move very, very fast as well. And so we want their experience to be fluid and consistent. And so we don't want to know what your order is. You can't call us and say, I'm going to buy 100,000 shares. That's not what I'm saying. That would actually take me out of the market, right? Because it would give me information I can't have. But you can communicate through the capital markets teams and different people to say, hey, look, can you just make sure that, there's liquidity in the market today? We think it might be busy. That's absolutely adequate and a fair request.
Yeah, I think that that goes to one of the points we talked about is having conversations with your LMM so they can understand what your distribution plan is, right? It's so important to understand what the distribution plan is. Is it a retail focused product? Do you have advisors who are going to buy it? How does the LMM kind of become a partner with you in your distribution of an ETF?
I wouldn't say the LMMs are generally partners. Obviously, we'd go out of our way to introduce them to potential investors because that would, we'd get to check the box that we're a value-added partner. But, we are curious about distribution. It kind of sets our expectations. I said it before, there's an expectation. If you don't have a distribution plan and you're just going to launch the product, we're probably not going to expect much to happen in your ETF. We'll quote it and we'll be out there, but if you don't have a distribution plan, we're probably going to put an expectancy of very low flow and very low inflows. But it is important to get that communicated so that we can prepare ourselves. There was a guy on the Amex that was from the Amex back in the old days, Dan Dorfman. I think he wound up going to jail, or something like that, or got fined for something. But he used to do this like midday report and pick a stock, and the stock would always go way up or way down and everything like that. They called it the Dorfman report. My point is if you're going to be on CNBC or some news channel bragging about your ETF, you might want to call your capital markets team and let them know, let the street know there's going to be noise. It helps market makers sort of say, all right, I should probably pay attention. What if, right? Just like we do for economic releases, just like we do for Fed announcements and things like that, we take action to make sure that we're adequately in the market to meet aggressive supply and demand. So just, again, it's a fair warning.
I think also, not all distribution plans are created equal. I think all day, we talk to different people who are coming to the ETF market, and they're all thinking about different ways to penetrate different client segments, whether it's the RIA channel, insurance channels, retail channels. People who are thinking about it particularly thoughtfully don't just say, hey, we have a handful of wholesalers dialing different numbers, traveling around the country to try and wave in assets. There's a compelling cause for why they're introducing a product to the market. They are maybe tackling a specific segment. Maybe they're cross-selling other products. Maybe they're selling against an existing product. It could be a tax loss harvesting trade. A lot of these initiatives from the wholesaling community and the ETF issuers are really important. And we've seen hundreds of different types of products and issuers come to market, and the level of scrutiny and the level of specificity that people go into when pitching it is really important. And that's something that I think all three of us probably evaluate to some extent when deciding whether or not to take on a lead market making obligation.
And to that point, also with when you speak to your lead market maker, and one of the concerns that we would have, or my two friends over here would have, is that a situation where you convert a mutual fund or a SMA, you have say for argument's sake $50 million or $100 million in assets in it. You launch it into an ETF, and then you depend on the white label provider or someone else to kind of sell your strategy, whereas you might have had this strategy going for 10, 15 years, have a track record, your customers, and they stop selling it. And then we've seen multiple products where they stop selling it and the assets fall off, just through attrition over time. So distribution plan, number one. Another kind of thing that's kind of helped out on the LMM side is that a lot of the issuers with their fund administrators and the custody banks have worked on getting smaller unit sizes for the ETFs. That allows for a new ETF that may not have a lot of traction or a lot of interest in it. From a market making standpoint, we're still held to all the rules that the equity people have. So if we get short and we can't buy, we'll keep getting short. You get reg showed, buy-ins, and all that. And if we're not going to go out and before, when most of the time the creation unit size were 50,000 shares or 100,000, if I'm short 5,000 shares, I'm not going to create 50,000 shares and then be long now 45,000 if the ETF is going to have continued liquidity, continued interest and continued volume coming into it.
It chews up balance sheet. So, yeah, it chews up the balance sheet that was talked about on the previous panel. If to Josh's point, they make markets in so many ETFs. The unit sizes being smaller allows them to turn those over more frequently and not lock up massive amounts of long-short balance sheet. Balance sheet's expensive. I mean, I know you know that, but with 3,750 products and potentially another tidal wave of products coming if share class happens, keep an eye on that. The cost of doing business will not always stay the same. Just worth noting.
Yeah, we've talked about the growth of products, and a lot of that growth has been in products using derivatives, more levered inverse, option-based strategies, more exotics. Is there anything that's too exotic? Are we going to see a levered in inverse version of every single equity out there? Can the market makers cope with it? And what do you see as? Is there anything that's off the table, just too exotic?
Yield to Josh. I have a feeling he knows.
Well, I do think that given the change in political regime, there's going to be much fewer guardrails for products that can come to market, which means that there will probably be a meaningful more amounts that are going to come very much of the exotic nature. I think that could even extend to different crypto assets. I think private assets, like mentioned on the last panel, will be a very meaningful wave. And I think all of these things can be addressed and quoted by the market making community. It's not trivial, it's not simple, but it's certainly something that can be done. For things that are too overly exotic, I think that's probably important is that each market maker and LMM sort of has like a different DNA, if you will. Certain products that fit flow traders really well might not fit Old Mission very well, or products that fit Murray well might not fit flow traders well. And I think by discussing with all these different providers, you get a really good sense of who is able to do certain asset classes, who has a competitive advantage in a certain asset class, or some asset classes that they avoid entirely.
Yeah, to that point, I mean, the Old Mission markets, we've been around on the LMM business for about 2 years. We're up to like 150 products now that we're supporting as a lead market maker on the 3 different exchanges. Out of that 140, 50, there's probably about 40% of options-based products. The majority of those would be the buffered products, defined outcome stuff, simple covered call strategies. Then we've kind of gone into the zero date option products now, which are really, really taken off. And we are kind of with a firm like us, we have a pretty robust options trading business, index options, SPX, NDX, Russell, all that type of stuff, ETF options. So the ETFs kind of like how when fixed income ETFs came out, where the cash business, the cash bond business supported the ETFs. It's really now like the options business is supporting these options products. So if you're members of the exchanges on the option side, you're able to find liquidity. You have the capital to take down larger blocks and and not basically and give clients a fair price, the end user a fair price. I mean I think that's kind of the other part of the equation.
Look, I mean, I think the market making community is very creative, and they love solving for difficult products, right? I mean, I think you can come up with just about any idea and bring it to market makers and ask them what they think. And we're really, I think I speak for most market makers, we're not in the business of betting on whether or not your product goes up or down or outperforms the market. We're really always kind of looking at it from the lens of, if this comes to market and if I need to make a market in it, do I feel confident that I can do it without taking too much risk? We are arbitrageurs. We're not risk takers in general. So have conversations with market makers and talk about your strategy before you come to market. Oftentimes, I would probably suggest you do it before you file, especially if your product is very unique or what might be deemed as complex and unordinary. Have conversations with multiple market makers, feel them out, and say, if I was to bring something like this to market, would you be able to support it? If you get across the board probably nots, you might want to rethink going out in an ETF wrapper and might want to stick to some other non-ETF wrapper. But if you get consensus across the board or you get a high degree of confidence from someone that says, yeah, this will fit or I'll figure this out, then go for it, But just remember, the newer and more unique it is, the more likely it is we don't have a widget built specifically for that. Developing and allocating resources to fit it into the various models that we have and the various risk systems that we have, it's time consuming, it's resource draining, and if it's not going to go anywhere, it might be hard for us to get, to go to bat to get it added if it's really unique and really new. So just keep that in mind as well. If it's not going to trade, we might not be able to, stop everybody and commit, resources to that. But have the conversations early and don't file and then find out you're a week from launch and then start talking to market makers about whether or not they could support your product. Talk to them first and then work with the professionals to go through all the legal hurdles of setting the trust up or joining a trust and, picking a custodial bank and picking a sub-advisor and all of these things. That takes time. So have conversations with the market makers early, get a sense of what their appetite is to support your product. And then after you go through all the pain in the butt stuff, you come back to the market makers and say, okay, we're ready for launch. We're going to start interviewing for LMM, and you go from there.
And to provide like a little bit more of an example, like we've gotten requests on everything from like physical diamonds to physical uranium. And surprisingly, we've spent like way more hours than you would think trying to figure out if something like that is feasible or doable. Mostly because we think that's like a large addressable market. And if you're able to package that into an ETF, we want to be the ones who are effectively, like Chris said, problem solving, puzzle solving, and seeing if it can work. We're not totally in the space of judging like, hey, we think this product is going to take off. But if it's a big addressable market and it's sort of not within the normal confines of a domestic equity large cap strategy where we can, we've known how to do that for decades and decades. But part of what we're trying to do is figure out how can we put new assets into an ETF. Is this something that's within our means? Is this something that we think we're capable of? And that's what we are effectively doing when we're talking to issuers who have complex or unique ideas.
Bitcoin. I mean, I think everybody expected Bitcoin in an ETF wrapper to be very popular, but it was new and it was novel. It's not physical gold, it's a crypto asset. So it wasn't so standard. I mean, even though I think most of the firms have experts in the space who are familiar with how it works, In the ETF wrapper, it was new, wildly successful. Were the spreads wide in the first days? Yeah, they were. You know, it was a little bit dislocated, but there was so much demand that it was just I think the street generally was overwhelmingly happy and surprised with the success of a product like that, and Ethereum behind it. So to your point, yeah, I mean the physical diamonds conversation feels like it's a decade old, but you know, I still don't know how to solve for it.
Well, in a lot of cases, it's not solvable, right? Like the underlying asset isn't really meant to be put into a wrapper that has daily liquidity, and like that's sort of the consensus that we came to. But something like Bitcoin, we probably spent 4 to 5 months coming up to the Bitcoin launch, trying to figure out all the different facets of the Bitcoin product. The custody side, dealing with the ETF, being able to deal with the spot leg of it, because we're a liquidity provider in the actual spot side out of our European entity. And it's not to say that it was trivial, but it was a new product with new workflows and new people kind of in the ecosystem. So we spent months because we thought that the product was going to be successful. And then we were ready to quote, the products, be a lead market maker on day one when it launched in January.
Yeah, to that point also, I mean, if someone comes to like our firm and says, hey, I have another S&P 500 ETF to come out, and I'm just going to charge like 1 basis point less in management fee than the 50 other ones that are there, that's less of an attractive product unless there's like a larger kind of relationship there with the asset manager. If you're coming out with something that, not to be as extreme as like a diamond product, but something that's kind of like as something that makes it differential than what's out there in the market right now, and you're looking, and our firms, Flow, Murray, Old Mission, a lot of smart people. They're constantly looking at markets. They're constantly looking at liquidity. They're constantly looking at what kind of derivation of a product that's out there already kind of would spark the interest. So something that is new is kind of has a wrinkle compared to what's out there already. And the trading firm, like with the consulting with the trading firm, the fund administration, custodians, the issuers, kind of like, hey, this is what the demand's out there. This is what we're hearing from our people in the field. Another example, kind of like, you have an issuer coming out with a product. They're like, hey, my product development guy has this one advisor like in, North Dakota that like, wants to put like $100 million into this product. Could you take it? Blah, blah, blah. And we take it, and you're sitting there and it's like, it's like watching crickets all day. The thing doesn't trade. No one has any interest in it. So like everybody has a vested interest in getting a product out. Kind of the LMM's job and the market making firm's job is to kind of like vet, like kind of like what really is commercially viable, or like what really is not commercially viable, and that's kind of like just being like the expert in the room. And also in that standpoint, like our biggest concern all the time when I talk to our traders is when we get a new product come to them, the first thing they say to the issuer or to the is like, hey, I want to make sure that I'm not over promising, and I don't want to under promise, and I want to make sure I'll be able to take your product and do a good job, and to be there from 9:30 until 4 o'clock, making a fair and orderly market, and providing liquidity so your customers have a good experience, getting into the ETF, and then in the unfortunate instance where they want to get out of the ETF, have that process be as easy as possible, and a lot of that has to do with having a good market maker, a good lead market maker is putting liquidity out there. And have a great redeem mechanism that is efficient.
So Steve said commercially viable, and that ties right back to what Liz was talking about a couple of panels ago. Why do we make markets in these ETFs that don't trade? What is it? Now, there are some benefits to making a market in a bunch of ETFs. The revenue that comes from SIP, there's rebate structures and things like that are geared to market makers. And so a firm that trades as much as, Old Mission or Flow Trader across all tapes, it may be beneficial for them to reach certain tiers as a market maker, whether that's lead or secondary. The enhanced rebate over massive amounts of volume starts to add up. That's one incentive that really doesn't involve the end investors. It doesn't really involve the managers so much. They don't really think about that. But look at a firm like Murray. We don't make a market in as many ETFs as they do. So the rebate really doesn't come into play. And I think to some extent, probably to Steve as well. There's a rule, and Jim's over there probably going to cringe in a second. There's a rule that prohibits managers of ETFs from paying ETF market makers explicitly by way of check, which is not a rule in Europe. The rule predates ETFs. It goes back to the floor of the stock exchange, where they didn't really want Warren Buffett calling his specialist and giving him guidance on where he wanted the stock to close, and he pays him $20,000 a month for that, privilege. So they have this rule that says you can't pay the market makers. They didn't want weird activity happening. But with ETFs, because they're fair game for all market makers, they're naturally efficient. If an ETF tried to if a market maker tried to mark up an ETF just for optics, one of the other market makers would quickly knock it back into line, because they can create and redeem and they can capture that. So no ETF market maker is going to do that, which basically makes Rule 5250 a silly rule to have for ETFs. Now we're working on some language and things to potentially address it. At securities traders, we're talking about it. There's no deadline or anything like that. So what is commercially viable to a firm like Old Mission or Flow Trader or Murray or some of our peers that aren't here today? Commercially viable is us going to the corner office and saying, I want resources to allocate to making markets in this suite of ETFs or this ETF for this manager. And if our bosses are smart, they're going to say why. What is it? What's in it for us? How much are you going to make making markets? We're probably going to say nothing. We're probably going to lose a little bit of money because the amount of resources we spend making markets doesn't offset the cost of making markets. But what if that manager is a prime brokerage client? What if that manager is a securities lending client? What if that manager is an agency trading, partner that pays a lot of commissions? What if that manager does banking deals with the institution or anything along those lines? There's a lot of different ways that broker dealers get paid. And so if I turn away an asset manager who has a commercially viable relationship with my firm simply because I'm not going to make money in their ETFs, and then they take that commercially viable business to one of my competitors, I'm probably going to have some tough questions to answer to my bosses. So we kind of use this lost leader kind of commentary about making markets in ETFs that don't trade a lot, right? We need a commercially viable excuse to commit resources to you, and you need to be thinking about that. Liz also mentioned on our panel that a lot of these older managers, they work with institutions that aren't so ingrained in ETF market making and AP activity and things like that. If you're one of those managers and you're getting into ETFs, think about where your wallet is in any capacity, and think about who's getting your wallet that can help you in your ETF launch. If the answer is none of my counterparties, you probably need to start thinking about adding a couple more counterparties into your wallet. It's as simple as that. And you'll be surprised at how fast firms like ours will turn around and talk seriously with you about using our balance sheet and using our technology and resources to support your product on exchange.
I think that's a good transition. We've talked a lot about LMM, but this is a trading panel, so I think we should also talk a bit about people who are trading the ETFs themselves, the portfolio trades for the ETFs themselves. All of your firms, besides being LMMs, you also work with managers who are trading for the ETF portfolios. It's something I think it's particularly a focus for active managers, right? Active managers who may not have managed an ETF before. What are some of the things that they should be thinking about when trading their portfolios? What should they be concerned about? One of the concerns we hear most is that an ETF is transparent. People are going to see what I trade every day, right? What are the concerns there, or some other active manager concerns?
To that point, there's some ETF issuers that have been around for a long time that have had active strategies that are fully transparent, which means like every morning you come in, you know exactly what's in the ETF portfolio, or even the night before, I guess. And they've been successful. It really comes down to what kind of ties back into distribution, knowing your clients, know who wants to buy into the strategy. There's been several other kind of iterations to that, like the semi-transparent model. There's like a NYSE model. There's a Fidelity model where they use a proxy basket. Yeah, there's Tractor. They all use proxy baskets. There's Presidian that was fully non-transparent. Truly fully non-transparent, where it was like you just had basically made your market based on what securities that were in the ETF. So U.S. equities, you kind of have a very big realm of securities to look at. So it's pretty easy to come up with a price. But I would say like the distribution, know your customer, and if you have a strategy that's worked and you know who that end user is, and you can position that person to kind of invest into the ETF, I think you should have a winner there. but it's definitely been proven multiple times by that fully transparent active strategies can gather assets and are successful.
You know, and in terms of trading the portfolio, rebalancing the portfolio, there's a lot of questions. You know, our firms will ask ahead of that. You know, if your fund is tracked very heavily by the broader street, by most of the banks and some of the proprietary trading firms and things like that, they know you're index based. They subscribe to the index methodology. Your fund is probably pre-traded. And so when the actual effective date of your rebalance comes to date, there's a good chance that you're going to have some really big orders to buy and sell that would ordinarily disrupt the market. But you'll be pleasantly surprised when the entire other side of your orders shows up at market on close and there's zero slippage. And it's, how did that happen? We just traded 8 days of volume. We put it all down to the close and it paired off and it didn't move the market. Well, that's a good thing, because it means there's a lot of eyes on your fund. You probably have a lot of assets, and that's a really good outcome for you. Think S&P 500, think Russell, and then you could go down the line. If you have an ETF that's successful and has meaningful assets, and your portfolio rebalance is large relative to the liquidity of the portfolio, and you're not tracked very well by the broader street, you should be having conversations with your counterparties about trading strategy on how to effectively and efficiently get these trades done within the rules of your prospectus. Now, some ETFs have looser rules than others in terms of tracking and things along those lines, but it's important to work with your sub-advisors to know how much leeway you have on tracking error when it's in the best interest of the fund. Everything always has to be in the best interest of the fund. I think that goes without saying. So again, if you think you have a complex rebalance, don't wait till the last minute. You should be talking to people ahead of time. You don't have to broadcast it to the world, but you can say, hey, look, we have a situation. We might need balance sheet and we might need help. And we're going to have a whole bunch of questions on how you want us to work with you on that.
We've also seen active managers use these large rebalance days effectively as a liquidity event. If you think of like the Russell Recon Day, massive day for a ton of different small cap liquidity. Stocks that might trade, 10,000 shares a day might be trading hundreds of thousands that day. So we'll see active managers take advantage of that heightened liquidity from like the index rebalance to effectively put on and take off different positions. It's a little different if you're actually leveraging someone else's balance sheet, because on quarterly rebalance days, typically balance sheet is something that's scarce. But if you just need to trade a ton of, a small cap healthcare name, looking at actual index rebalance days where there might be heightened liquidity in a certain product is a really good tactic. And then we've seen a lot of active managers take advantage of that.
Yeah, and check to see if you're on the right side. If there's a big addition to an index and it's going to be a massive buy and you're also a buyer, you might want to think about it. Maybe I don't want to be in the market that day. Maybe I want to wait till Monday and not do it on Friday. If you're on the other side of the index move, which, you're an active manager, you have every right to be, then of course, yeah, you want to, take advantage of that market activity, 100%.
The description for the panel said that we talk a little bit about T1, how it's affected the ETF industry. This is the first panel, I think, since T1 actually happened. I'd say generally speaking, it hasn't really been disruptive to the ETF market. But is there anything we should think about there in terms of creates and redeems, and now we have like this disconnect between many developed markets that are still T2 in the US, which is T1. Any challenges there with either market making or creations and redemptions?
So far, from our standpoint, it's been a very smooth, kind of like a Y2K event with T+1. There was a lot of preparation going into that by our firm, our clearing firms, conversations after conversation after conversation. It happened, no issue. As Andrew mentioned, the staggered settlement now, and we have like a global basket where the U.S. is T+1, but some of the developed T+2, and some of the emerging is still 2+3. Also, a lot of those other markets have very strict buy-in rules where like if you don't match up to like the penny, like you'll get automatically bought in, and that increases the cost and increases the spread of your ETF. Because all those any kind of thing that doesn't make the ETF efficient is going to increase to the cost of making a market in that ETF. And the market makers, if they're doing the effective job of telling you really what the ETF is worth, they're factoring in all those different things.
Yeah, I mean, I think I would agree with Steve. It wasn't the T1 transition was not a big surprise. It wasn't very disruptive for us at all, if at all. One thing to keep in mind, though, if a portfolio has 50% US T1 stocks and Canada stocks, and then a whole bunch of T2, Europe stocks, depending on how we submit the create or redeem, we're probably going to be burning balance sheet for a day, either in the form of collateral or in the form of borrowed securities. So just again, it's not a big deal. We solve for it. It's just a conversation. It's the way the business is right now. When I guess when Europe goes T1, a lot of that noise will go away. But if we're borrowing securities or delivering collateral, there's a charge to that, and you need to be aware of it. It usually doesn't add up to a whole lot, depending on the size of the trade, but be aware.
And I think more broad stroke, the ETF industry in general is really good at solving problems, especially when they're properly forecasted. And T1 was so well forecasted for years, years going into the change. So we spent a ton of time internally behind the scenes making sure that we had our processes in order, that we were in good communication with the issuers. And to Chris's point, certainly there was increased costs, but we have changes in costs all of the time, from clearing arrangements, SEC charges, different AP charges, taxes on certain types of securities. So this kind of fell into the bucket of economic changes that go into being a market maker in ETFs. And it's something that we've corrected for, we've accounted for in our pricing. Is it anything so material? No. But, is it something that changed? Certainly.
So we have a few more minutes in the panel. I thought I'd open it up. Does anyone in the audience have any questions?
Oh, Jim. It's coming right back at us.
I asked this question early this morning when the exchanges were up there. The liquidity programs that exchanges run for you, for the market makers and ETFs. Any concern among the group as far as the SEC rules around reducing the access fees that may kick in, and does that impact the liquidity programs? And then therefore, obviously, does that make more sense for Rule 5250 to be taken out and looked at?
So Jim, obviously, great question. So a firm like Old Mission, we're not in, there's some different market making firms. So another thing you need to kind of do your research and listen to ETF is what's the kind of DNA of the firm. Old Mission is an ETF market, a liquidity provider, ETFs, ADRs, fixed income, options, whatever. We're not a high frequency firm. So there's some market makers that are out there that'll just take domestic U.S. stocks because they just want to put them on exchange and collect rebates on both ways on it. Old Mission is not in the business to, no one's making money in the LMM business, as we've discussed earlier. It's kind of just to kind of build a relation point and be a touch point between the issuer and the end users. So for our standpoint, it's kind of like something that kind of smooths it out. But I would assume with a lot of other firms that a lot of their revenue is coming from those rebates. It's probably going to have an effect on that if it comes into play.
I would suspect, Jim, that the major wholesalers, without naming names, the major retail wholesalers have a lot more skin in that answer than I do, at least at Murray. So to Steve's point, probably a lot less impactful for us, but it's an important observation, I think. Because if you look at the number of firms that make markets in ETFs, it's not a big number. It's a small hand. I mean, it's about a dozen or so, lead market making firms. And you think about that, there's 3,750 products with potentially thousands more coming. What is our capacity? How many of the market making firms are solely dependent on that rebate enhancement or that rebate structure? I would venture to say, without measuring the volumes of everybody, it's a smaller percentage of market makers, even though that smaller percentage of market makers, because of the nature of their business, might make up a much larger percentage of the overall tape revenue. I guess it's a hard way of answering it, but I think it should be looked both ways, depending on who's asking the question. Is it directed at the wholesalers and retail order flow, or is it directed at market makers who support thousands of ETFs that don't trade a lot every day?
Yeah, and flow traders, we fall into that bucket of people who aren't, market makers who aren't doing that wholesale business. But we're also a European-based firm who has a vast majority of the lead market making business out in Europe. So for us to not have that 52, for 5250 to be imposed on, the United States markets, our European counterparts are still very confused by the ability that we can't get paid for market making in the United States. It's a core facet of their business and something that, they always are like, we think about European, fragmentation of markets out there. One of the things that they seem to have gotten really well done is that they're able to pay for market maker and have, good, high quality markets for when ETFs are coming to markets because there's that direct compensation going to the liquidity providers.
I think Danielle has a question.
Hi, I work at NASDAQ on the ETF listings business. So to answer your question from a exchange perspective, if the excess fee caps go into effect, all the exchanges will have to either get rid of their DLP programs or lower them drastically. So yes, there will be an impact. And, if you guys wanted to comment on, what that might look like, to their point, it's obviously not the entire revenue driver. It's not even the largest portion by any means. But if you are somebody that is worried about spreads and appreciates a liquidity program, then if you have the opportunity to, kind of have any feedback on that, that would definitely be a negative. And then my question from, the market maker community would be, there's a lot of talk today about, well, we'll redo Rule 5250, but that's not a perfect solution either. And in Europe, having worked with European ETFs myself as well, knowing it's not a perfect model, is there anything that you guys would change or almost kind of suggest in a sort of hybrid solution between what we have going on today, maybe how that could be tweaked if Rule 5250 isn't maybe completely repealed, but just changed in certain ways? Could we improve upon the European model?
I'll take a stab. Look, and again, our capacity is different, relative in size and age. But I'm willing to stand here or sit here today and say out loud, I will make markets in ETFs that have commercially viable reasons to do so without rebate at all. I don't do it for the rebate, and it's that simple. So what does commercially viable mean? It could be 5250 exemption, or it could be something else. So we're not in it for the rebate. It's that simple. So very little impact, if at all, with me. And I would imagine with Steve and Josh, it's somewhere in between, but if I can make it commercially viable by any means, then we're going to commit to the product.
Yeah, and that's exactly right. The rebates are something that we certainly look at and consider, and it moves the needle. If it moves the needle does it move the needle substantially? Not a ton, but it's all to say that it does go into our calculus when we're looking at taking on new products.
We have time for one more quick question.
Thanks. You mentioned, thanks for the idea about the wallet, and that was helpful about payments and about partnering. Back to the Bitcoin ETF, how big was that impact on the ecosystem from a revenue generation standpoint, from market making and the like? Did that punch above its weight, or are people doing loss leading just to get the volumes? Did it disrupt it?
The question was related to the disruption when Bitcoin came to market. What was behind the liquidity and I guess the profitability of the market makers. I'll yield to Josh because I know he put a lot of work into that, but you don't have to give numbers, but we know it was good.
Well, part of the reason that there was so much volume was that the SEC effectively said on whatever it was early January, on this day, all 11 of these products are going to list. So you had everyone kind of having this lead up period who are looking to effectively allocate to the product. It was a ton of retail, it was a ton of advisor flow. But the important consideration of that is a ton of it was true retail volume. And for a firm like ours, who's not so involved in the payment for order flow space, most of the volume we see is volumes that are trading on various exchanges. and volumes that are coming from institutional clients over the counter. So on day one, we saw some over the counter requests, but not a ton by any means. That certainly picked up, and I would say like in this current Bitcoin bull run, we've seen substantially more OTC requests in Bitcoin and Ethereum products than we did when both of those launched. And part of that's, you know, institutions having to get through different committees, getting more comfortable understanding with the product, fear of missing out on like the price appreciation. So it's all to say there was certainly high premiums on day one. They compressed probably by day three. But for a firm like ours who's not actively engaged with executing against retail in a payment for order flow capacity, you know, there wasn't as much juice, if you will, because of that.
Okay, so I'm going to interject here. I don't want to keep everyone from lunch, so a thank you for the panel. Really appreciate your thoughts on this topic, and also thank you to Exchange Traded Concepts for sponsoring our lunch that we'll be breaking for now.